As the country reopens, a new normal is taking shape. But what will it look like? Which businesses will struggle and which ones will thrive? And more importantly, what could it all mean for Americans in or nearing retirement? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, of course, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services and also the brand ambassador for the Retirement Income Store. Well, many businesses have been hit hard by the coronavirus crisis. Others have seen their fortunes rise and their fortunes brighten. And you know, it's not surprising, and it's something that happens in almost every humanitarian or economic crisis. In fact, on last week's show, Dr. Ben Carson, a member of the White House Coronavirus Task Force, actually compared the process to a forest fire. Yes, it's a disaster that destroys, but also clears the way for new things to grow. And to continue that analogy, the coronavirus crisis has been a massive forest fire, and to a large extent, it's still burning. However, even as it does, we're already seeing many new growth areas emerge, and many of them have the potential to flourish in the new forest taking shape, or the new corona economy, as we've been calling it. Today, we're going to take a closer look at some of these growing industries, technologies, and businesses, and how they may play into the economic recovery overall. We'll also share an update on the financial markets and give you some insight from our special guest, economist and author, Peter Morici. Also joining me as usual will be our co-host, Jeff Small. But before we talk to Jeff, let's talk about some of the changes brought on by the current crisis that have actually paved the way for new business opportunities. I'm sure you don't need me to tell you that life has changed during this pandemic. It's changed dramatically in some ways. How we greet one another, how we shop, how we work, how we communicate, how we get our entertainment, how we visit the doctor, the list goes on. We've done all or most of it differently in the past 2 months. Those differences have been central to determining which businesses and areas of the economy have suffered most during this pandemic and which ones have flourished as a result of these changes. Now, even as the country slowly reopens, it's been closed long enough for many people and businesses to grow comfortable with some of the changes. And that means the economic impacts, whether good or bad, could become permanent for certain businesses or at least continue for a while. Today's guest, Peter Morici, talked about this in a recent article, and he pointed out a few good examples. Many people who used to visit restaurants regularly after a day at work have discovered delivered meals, creating new opportunities for virtual restaurants and industrial kitchens. On the flip side, it's been estimated that as many as 25% of traditional sit-down restaurants that have closed during the pandemic may never reopen again. And if you are or had been working from home during the crisis, you're not alone. Many businesses have actually discovered they can get by just fine without subjecting workers to so much commuting and so much air travel. And that's great news for Zoom and other telecommunication companies, but potentially bad news for airlines, commuter trains, and even owners or landlords of traditional office buildings. Traditional brick and mortar retail businesses were already struggling before the pandemic, and many of the country's oldest department store chains were closing stores right and left. With more people than ever forced to shop online, that will likely mean more store closures moving forward. But more revenue for online retailers like Amazon, Etsy, and eBay. We'll talk more about some of the specific companies likely to continue thriving in this new corona economy coming up just a minute later in the show. For right now, it's time to bring in co-host Jeff Small, president of Arbor Financial Services, a retirement income store in Melbourne, Florida. Also the brand ambassador for our very own retirement income store, and Amazon best-selling author of the book, Turning Financial Planning Right Side Up. So Jeff, we talked about the industries that are flourishing right now. We talked about the industries that are shrinking or dying. What are your thoughts on how this whole thing is going to balance out between the positives and the negatives that we're seeing today?
Well, first of all, Dave, I've got to settle the score. And due to my competitive nature, I've got a bone to pick with you. I've been saying for the last couple of shows, for the last couple of shows, I've been saying the market was going to go up. So right now, optimists are prevailing, and money managers have to invest because there's nowhere else to invest because interest rates are at what, Dave? They're at zero.
Zero, yeah, basically zero. Well, okay, so I've got to concede that short term, you were right, short term. There's still more time to go. The game's not over yet. But, it's I guess, we're both income guys. You're a little bit more broader based in your thinking on income. And of course, I'm a bond guy. And you know that we bond guys are always kind of bearish on the market. So it really didn't surprise you much, did it, Jeff?
No, it really didn't. And I think that, we're going to follow this tone until potentially we have a second wave in the virus. And if the second wave is worse, then we'll see the market and the money managers will start to sell. But there's got to be a reason to sell for markets to drop.
Yeah. Well, I'm interested to see what Peter Morici says when we bring him on as our guest, in large part because he could be the tiebreaker here. I still think we have to have another major pullback in the markets, at least testing the lows from March or maybe even breaking new lows. So let's agree to make Peter Morici the tiebreaker. How does that sound?
That sounds good. I think Peter can maybe settle the score between us right now.
It is true. Don't fight the Fed. I mean, that's what you were saying. Your whole argument was don't fight the Fed. Whereas I look at it and I think about our viewers, I think of our listeners, Jeff, and I think about how a lot of them, some of them lost their jobs, and as a result, they really aren't going to spend all the money that the government's printed recently to help us all out. And those that haven't lost jobs or that are retired aren't going to feel as comfortable spending all the money. So I'm kind of surprised that even though economically we're still in the toilet, that the stock market has pushed this far ahead of itself. So although you're right, I have to tell you, I'm certainly surprised by it.
Yeah, I think the overall tone of most economists and prognosticators is a positive outlook on what's going to happen. We're going to have a really bad bottom. Numbers are going to get really bad here the next 30 to 60 days. But then we're going to expect it to be, we're going to recover. But Dave, I start to get into your camp when I worry about a second wave. And, the second wave really, really concerns me. And it should concern our viewers as well, because that could make the economic effects prolonged to the downside, which will affect the market if we don't have a quick recovery.
And you see, I guess that's kind of what's been fueling my thoughts, because I can't imagine how we won't have a second wave when we start to go back. Because one of two things is going to happen. Either people are going to start to go back to restaurants and hair salons and gyms, and then the infection rate's going to go up, or they're going to be too afraid and they're not going to go back in mass, in which case the economy is going to get even worse. As opposed to just having declines in the economy first quarter and second quarter, we could have third or fourth quarter. So it's almost like darned if you do, darned if you don't, whether people go back in mass or they don't. And that's what I'm trying to reconcile. But I think, what's most important for our viewers and our listeners is that they just stay conservative. They don't get too euphoric right now in light of this incredible stock market rebound that we've seen over the last several weeks.
Well, I think our old favorite two words, normality bias, people think that they're not going to make a mistake and they make the wrong, they know things can happen and can go wrong, but then they do the opposite. And they kind of take an ostrich approach and they bury their head in the sand. So I think they've got to be very careful at this time and watch the numbers. We just had 44,000 people in one day with the virus on Tuesday the 19th. I mean, that was kind of a crazy number. We're back down into the mid-20s today. But I think folks have to watch, is the virus going to expand on a daily basis in terms of the infection rates?
Well, even mid-20s is a pretty good number. We went in the month of April from about 200,000 infections to about over 1 million infections. And then we slowed down. So, just percentage-wise, heck, even if we end up at 2 million infections by the end of May, and I don't think we'll be quite there, but even if we do on a percentage basis, things have slowed down significantly. And that's good. But hopefully, as Dr. Ben Carson said, we won't have people won't construe this as, everything's normal again. Reopening does not equal normal. We still have to use face masks. We need to be conservative, social distance, and really follow all those protocols. And it's to me, it's kind of like the new norm. Jeff, think about it this way. We had 9/11. All of a sudden, we're all freaked out thinking that gosh, we can get attacked on our own soil, and everyone's panicked by it. And now we've kind of calmed down a lot. When, I thought back to like what the poor Israelis have gone through, right? I mean, they're so used to getting attacked on their own soil that every Israeli citizen just walks around and they know it's a danger, it's a way of life. And there's some countries that have the same thing with disease. They're just used to it. They've just learned to deal with it. A lot of people from other parts of the world have traditionally walked around with face masks in airports and other places. We used to think they look stupid, but maybe, maybe we're the stupid ones, right?
I think you're right, Dave. I think the new norm is, hey, the virus is here. We've got over 5 million cases globally. It's expanding in the Americas fairly rapidly, other than the United States, as rapidly as the other countries down south in South America and Central America. And so, I mean, I don't know, we're forming a new economy and we're accepting the fact that the virus is here, but we're going to be doing things on a limited basis. It's not going to be the same.
Yeah, absolutely correct. So it'll be interesting. I'm interested in getting Peter Morici's feedback on the economy as a whole, like how long he thinks it'll take before we get the economy back to the same size it was, what the second half of the year might look like. Everybody knows the first half's kind of a write-off. But then most importantly, Jeff, I'm interested in having him come and be the tiebreaker about what he thinks the stock market is going to do moving forward. So
I'm sure he'll agree with me, but I really want to know how he ties a bow tie.
Well, I don't think I want to waste time with that. You remember years ago we had a show where we went ahead and asked him that question, had a whole conversation. But we have too many more important things to talk about right now with this euphoric market. So let's take a quick commercial break. We'll be back here in just a moment on the income generation. I'm David Scranton. I'm with Jeff Small, and we will be right back. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
Let's face it, without federal help, the entire airline industry would likely have gone bankrupt due to this crisis. Many restaurants, salons, retailers, and other traditional businesses that rely on crowds and rely on live customers are struggling or have already failed. And that's why unemployment is already at its highest level since the Great Depression and could eventually end up being even higher. Yet, in the midst of all this, some companies are hiring, and prospects for new jobs and new opportunities with these companies could actually increase as this reopening continues. We already mentioned the video conferencing service Zoom, whose stocks soared during the pandemic, and online retailers like Amazon and eBay, for whom social distancing has been a boon. However, they're not alone. Large companies like the pet supplier Chewy and the meal kit company Blue Apron have been blindsided by surging sales over the last 2 months. The same is true even for many smaller companies and startups whose business models suit the changing world. One example is Clean Cult, a venture-backed startup that manufactures natural cleaning products in zero-waste packaging. As people have struggled to find cleaning products in stores, Clean Cult says its Amazon sales have increased 8 times over in the last several weeks. And speaking of cleaning products, it shouldn't surprise anyone that Clorox, which makes about half the disinfectant wipes in the United States, has also seen its revenue skyrocket. Even better, Clorox has a sideline in packaged foods, which is another industry that has thrived during the pandemic. Now, obviously, fewer people eat out. It actually has meant that more people are eating at home. That it also has meant higher sales for everything from peanut butter to frozen broccoli, which explains why bare shelves at the grocery store have been a common sight. Big, diverse food companies like Smucker's, Nestle, and Kraft have obviously benefited, even though keeping many plants operating at full capacity during the pandemic has been a challenge. And finally, pharmaceutical companies like Regeneron and Gilead have been working overtime to develop drugs to help treat the virus and help protect against it in the future. These also have felt a positive impact during this economic crisis. So what role might these businesses and industries play in the recovery going forward? We'll talk more about that coming up in just a bit. And that's where I want to bring in our co-host, Jeff Small, along with our guest, Peter Morici. Peter is a professor at the Smith School of Business at the University of Maryland. He's also a former chief economist at the U.S. International Trade Commission, and you could follow Peter on Twitter at pmorici1. Peter, thanks for joining us today.
Oh, it's always a pleasure to be with you guys.
You know, you probably remember this, but 2-3 years ago, we had an interview on television where I started asking you about how to tie a bow tie. And we had some fun with that, but I've got to tell you, with what's going on right now in the economy and the stock market, we have far more important things to talk about than bow ties. So, what do you think is going to happen economically in the second quarter, right? First quarter numbers, the GDP was down almost 5%. We're opening up, most states are opening up mid-second quarter. So how do you think second quarter is going to look from an economic standpoint?
The numbers are going to be shocking and disturbing, simply because we have 40 million people who filed for unemployment. So you figure the average unemployment rate in the next quarter has got to be measured and unmeasured, because some of it's getting missed, around 25%. I mean, it'll get worse and then it'll get better, but it's going to average 20 to 25%, which means that GDP should be down, at least 15% on a quarterly basis. So annualize that and you're up around 60. And the number could be bigger. But you shouldn't take it too seriously. The question is...
So hold on, Peter. Did you say 15 or 50?
No. The actual decline will be 15, 20%.
Got it.
So the annualized rate, the way we publish these things, what is, if we did this for 4 quarters in a row, what would it be? That would come out to 60 or so.
Sure.
60 to 80. So you shouldn't take that number. I mean, that's going to be a bad day in the market. Yeah. It's just going to be, everybody's going to have, at least for an hour. Okay. Mm-hmm. And then everybody will sober up and realize that was forecasted. The question is, where are we come October, November?
Right. How are we third quarter? How are we fourth quarter? Exactly.
Right.
So are we going to, are we going to be able to gain back that 25% in the last 2 quarters? Are we going to be able to gain back half of that? I know it's a kind of a guess to some degree because it depends upon the virus, but you tell me what you're thinking at this point.
Okay, suppose that there's no second wave. Mm-hmm. Then by the end of the year, we should be recovered, or into the winter, we should be recovered to about where we're going to recover to. And that won't be 100%. I mean, a lot of places have closed permanently, not just restaurants, but some small manufacturers and so forth. So that means probably we're going to start from a base where the economy is about 10% smaller. Now, to tie it into what we'll talk about later, the stock market is about 10% off of the beginning of the year and a lot more than that off of its February peak. What that means is we probably have some room to continue to go up this year, but we shouldn't expect to get back to the February peak until next year. We can talk more about that later.
Now, well, and I know Jeff's chomping at the bit to talk to you about the stock market, so I'm going to turn it over to Jeff.
Hey, Peter, Jeff here. Hey, listen, the last 10 years are going to be nothing like the next 10 years. And earlier, before the pandemic hit, people like Robert Shiller, people Warren Buffett, were having a very negative view on what the rate of return was going to be on the S&P for the next 10 years. So for longer-term investors who are looking out 10 years beyond the pandemic, where do you see the actual rate of return going on the S&P 500 on an annualized basis?
Well, the S&P 500, the price earnings ratio is the inverse of the earnings price ratio, obviously. And let's compare that to bonds. With bonds are really cheap. And the issue here is that bonds are going to stay cheap no matter how well the U.S. economy does, because there's such an excess supply of savings in the world. China's such a risky place for for portfolio investments. And Europe, frankly, can't get its act together. With that in mind, the sustainable S&P price ratio, the average, the 10-year moving average, the 20-year moving average, the 50-year moving average, whichever you want, has been trending up. And so the 23 that we accomplished in February maybe was a price to perfection, but it was sustainable in terms of the long-term trends. So my feeling is once we get back to normal, the economy is 10% smaller. Getting back up around 22, 23 is just fine. Remember, large companies are going to do better in the recovery than small companies. The small companies, the companies that are not that are below mid cap, and those that are not incorporated or sell on the exchange at all or whatever, they're the ones that are taking the hit. So my feeling is we're in an era of big companies because of global markets. Globalization is not going away. So the kinds of numbers and analysis we used, before the crash will apply again. As for my friend at the University of Pennsylvania, my question for you is, do you ever recall him being optimistic about housing or asset prices?
Very rarely, actually. So.
Very rarely. Now, if you had used him for your investment advisor, where do you think you'd be relative if you had used David?
Well, you wouldn't have the same return, that's for sure.
Or
Peter.
me.
That's correct.
Okay? So I think that you should consider that. They give Nobel Prizes out for lots of reasons. Most of them are not for real market savvy. If you want an example, just read Paul Krugman every Sunday in the New York Times.
Very true.
That's great. That's great. So I get it. You think third quarter and fourth quarter will regain actually probably 2/3 of the economic shrinkage we've seen first and second quarter. But the stock market can still have potential to grow next several years. So we need to take a quick break. We'll be back in a minute, coming up right here on the Income Generation. We'll be right back. Hi, I'm David Scranton. As we reopen America during these difficult times, we're all practicing social distancing. But at the Retirement Income Store, we're also practicing stock market distancing. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Now, as we've discussed, despite the overall economic devastation, the coronavirus has benefited some industries. And as a result, many companies such as Amazon are now hiring or will be hiring in the near future. Now, while that's a silver lining in a dark cloud, it's not going to chase the cloud away anytime soon. There are still far too many unknowns to determine the extent to which companies that have grown during the pandemic can actually offset the economic damage caused by those that have struggled or completely failed. For now, the balance is weighted heavily toward the damage, with furloughs and layoffs far outpacing the number of new jobs being created. Now, whether that balance changes and by how much depends on a variety of factors. For example, how fast and successful will the reopening be? Will a resurgence in COVID-19 cases completely derail the efforts, or will it just slow it down? And if not, will people rush right back to restaurants or continue using new takeout services, either because they've grown accustomed to it or because they're still nervous about the crowds? Will people feel comfortable still in packed movie theaters again anytime soon? Or will they continue watching new films via Netflix or other streaming services from the comfort of their homes? Will people continue using hand sanitizer and disinfectant wipes more than they used to? Will they settle in the habit of doing all their shopping online even after retail stores are open again for business as usual? If so, does that mean they'll be doing less shopping or more? Will businesses that used to operate from a central office go completely or partially remote, prompting them to downsize their office space or abandon it altogether? These are just some of the questions that will help determine what the new Corona economy looks like and what role companies that have found a lucrative niche during the pandemic will play. However, determining the answers to those questions will take time. To use Dr. Ben Carson's analogy of a forest fire, the new growth enabled by the fire doesn't instantly replace what's been destroyed. It's actually a very slow process. In the meantime, the imbalance between economic damage and economic opportunities is likely to remain weighted on the side of damage, meaning high unemployment, high GDP shrinkage, and significant recession. Although the financial markets haven't fully acknowledged this reality yet, I believe they will eventually have to. And we'll be talking about that coming up in a little bit. For now, let's bring back in co-host Jeff Small, along with economist and author Peter Morici, whom you can follow at Twitter at PMorici1. Peter, thanks for sticking around.
Oh, nice to be with you again.
So, hey, this whole issue about maybe having a 2/3 recovery between now and the end of the year, is that what you were referring to when you wrote the article about a kind of a truncated V-shaped recovery?
Yeah, I mean, it's going to bounce back, and it'll bounce back quickly, but it's not going to bounce back to the same level. Now, one of the things to understand, when you're engaged in events that are much further from the mean than your historical record, we haven't seen unemployment rates like this since 1933.
Yeah.
The quality of economic modeling becomes very, very dicey. Essentially, your 95% confidence interval becomes much, much broader. It's one of the things you learn first semester graduate econometrics, that we even have a little graph for it,
right.
Like, when you're way out there, in a limb, don't saw yourself off. So, the difference between saying 2/3 and 3/4 is kind of like saying, who do you think is going to be in the World Series next year? The answer is, it's really an awful.
Yeah. Well, when I hear 2/3, I think half to 3/4, and I think with that big if, you put a disclaimer on it that we don't have a second round of significant infections.
On the other hand, now you know why economists have two hands.
That's right.
Because we can't control things like viruses.
That's right.
Now, the thing to remember is that viruses usually do have an echo effect. There's usually a second wave, and it really doesn't mean that the economy isn't going to bounce back as much as 3/4, but it really comes down to, are we willing to then suffer through the second wave as opposed to repeating what we just did? And I would suggest that in most places that would be foolish. Let's face it. Do you think there's many people on the island of Manhattan or in Westchester County that have not been exposed?
Yeah. No, a lot of people have, and a lot of people have developed immunity. We just don't have the ability to test everybody yet. That's the real issue. But I want to ask you something, what you said to Jeff, though, about the stock market. You talked about a 7% maybe average growth rate per annum over the next 10 years. Is part of that because of the low interest rate environment that we're in right now?
No, I think that the low interest rate environment gets us to 23, 25, 27 on the price earnings ratio. But once you get there, that's your adjustment for that. And again, we're well outside what we normally experience in America. So that, doing price earnings ratios back 50 years against interest rates 50 years is only going to give you a broad indication. But we're going to get to some sort of price to perfection again, a well-priced number. And then from there, it's 7%. The trick here is that in order to do really well on the market, it's easy to say, well, you got to go to high tech. Well, at some point, high tech gets priced to perfection, and it's 7%.
Sure.
The trick here is to pick up those stocks that have been undervalued because they are going to have some bounce. Like, say in the cruise line business, not everybody is Carnival. it's really hard for me to understand how you can make a Carnival boat safe. But there are other cruise lines that operate smaller boats that are able to deal with this better. So, there's an example. And the other thing is picking off people in artificial intelligence, robotics, things like that.
Sure.
Picking off real estate in Manhattan. Let's face it, right now, they're all panicking in New York. The banks are going to open up. They're going to spread out. They're going to move to New Jersey and Long Island. I would move to New Jersey because it's got lower taxes. But they're going to move away. But the point is, the logic of Manhattan comes back when the virus is tamed. I mean, do you really want people spread all over the place? So probably Manhattan real estate is going to get a bigger hit. The real estate investment trusts are getting bigger hits right now than they're going to sustain. And of course, that takes good, strong investment.
Okay. Now, Jeff, why don't you bring it back to our viewers? What with what we need to know
if
from
I'm a
Peter
viewer,
about...
if I'm a viewer, Peter, I'm saying, wow, you are really optimistic about the future financially. Even though you're using history as the barometer for that, if I'm a viewer, this is what I'm saying. This isn't me speaking, Peter, but the reality is the evidence-based science says that there will be multiple surges of the virus. And we know in the Spanish flu, under the second surge is when we saw the Dow really start to decline and go into a long-term protracted correction. There's a really good chance we're going to have a second surge, and most of that will be caused by people making mistakes and not safeguarding enough, because this is a very highly transmissible, virus. If you're an older person over 60 and you're retired and you're not going back to work, under the short term, what type of risks do you think they're facing if they're stock-based at this time in those scenarios, Peter?
They're very vulnerable because they haven't prepared themselves correctly. And so the best they can do is to shift to dividend stocks. So they can catch the rebound if they get it. And they'll still get their dividends. Even, let's face it, Procter & Gamble ain't going out of business. So go to dividend-based stocks and ride it out with an eye towards the fact that, say, the petroleum industry's long-term prospects are not great. So you certainly want to go to dividend-based stocks that have good long-term prospects for when the economy recovers. It's too late to jump into bonds because bonds can only have downside risk now. I mean, I really doubt that America is going to negative interest rates. They have more options over there than they admit. So, that's where I come on that. Hopefully, if you're an older person like myself, you're like myself, and I have half of my money in fixed income, cash equivalent, get out money, so I can ride out 10 years. Because we may be looking at a long haul here, like you described, that I cannot dismiss your scenario.
Yeah, no, that makes sense, Peter. It's you're right. Whenever I always tell people, when you invest for the I instead of the G, the income instead of the growth, at least you have a bird in the hand. You're getting some component sent to you on a regular basis, and it just makes things a lot more secure. And that's why I always love having you back on the show, because you always, as smart as you are, you always have a nice, down-to-earth, common sense way of looking at things. So, Peter, thanks so much for being back with us. We appreciate it. And you look great without your glasses, by the way. It's a new look. We love it here on The Income Generation. And you stay with us. We'll be back in a moment here on The Income Generation. I'm David Scranton, and I'm here with Jeff Small. We'll be right back. Welcome back to the Income Generation Show. I'm David Scranton. I'm here with our co-host, Jeff Small. So, Jeff, what do you think? Peter had a lot of great things to say after that University of Pennsylvania comment, though. I'm just glad that I'm not poor Robert Schiller. He's got a. If there's a voodoo doll, he's got to feel like he's got knives in his back at this particular time after that UPenn comment.
Well, not only are you and I competitive, Dave, and we like to tussle, but also it looks like economists like to tussle as well. So what I found, though, with Peter was he was really optimistic. That really shocked me.
Yeah. So I've got to say, if Peter Morici is our tiebreaker, wow. I mean, he's more optimistic than even you are looking forward with it about the markets. So if he's our tiebreaker, then I guess I have to bow down and I kind of have to concede because, a bet is fair and square all day long. But do you think there's any merit to being that optimistic, because I see his argument, but to me, I only see ourselves being that optimistic if we really have a virus vaccine and we can make enough of it before the end of the year to inoculate everyone. Otherwise, I would not be that optimistic.
Well, look, if the virus disappears and we don't see it again in 30 days with $9 trillion of stimulus from the Fed and the Congress, the economy is going to explode. And so as a viewer, a listener to the show, you want to be super concerned about a second wave. There's going to be a second wave. There's no doubt about that. Evidence-based science says that there will be a second wave. And when that occurs, it's going to be worse than the first. And if it is, then that's going to really put a beating on the economy, and we could see a long, protracted correction in the market. Not a 30-day correction like we had in March or a 3-week correction, but a long correction over several months.
Yeah, because then when they reopen after that second wave, after that second closing, if that happens, then essentially that's going to have to be a lot slower. And I was kind of surprised that, as optimistic as he was, he did put the disclaimer on it, though, that okay, it's that's assuming no second wave. But as optimistic as he was, he said that if there is a second wave, he thinks that going back to your business is not the right answer, that people should come back, they should close the economy again. So I don't know how to put those two things together, because the economy closed down again really is not going to fare well for the stock market.
Well, I don't know either, Dave, but you know what? He validated everything we talk about on the show, and that if you're a viewer and you're part of the income generation and a listener, that you should not be overexposed to the market at this stage. And even in his own personal portfolio, he embodies exactly what we discuss every week.
Yeah, no, he does. And even when he talked about stocks, it made sense. He talked about dividend-paying stocks. We always talk about the universe of bonds and bond-like instruments, but he's right. With the bond yields being so low right now, there are other things out there that generate a really good yield for our viewers and for our listeners potentially, if they're looking to get income. And you could still get 4 or 5% income, net of fees, between a portfolio like what Peter talked about. So I was glad to hear, even though he talked about growth stocks and some of the technology and all that in a somewhat favorable way, at the end of the day, when he talked about our viewership and our listenership, the income generation, he said, no, go with dividend strategies. And obviously that's he's preaching to the choir with you and me, right?
Yeah, but don't forget, he did say he had half his portfolio in fixed income.
Yeah, sure. And I think his point right now, he said something about, well, bonds now are scary because they're so high. I think the way he's looking at it was, I bought them a while ago, so as interest rates drop, they've run up. But if somebody buys them now, they could drop in value. But as you and I know, in a true bond, it really doesn't matter, because at the end of the day, you hold your bond to maturity, and as long as you don't have bond funds, right? As long as you don't have bond funds, and Jeff, I know how much you love bond funds, right? As long as you don't have bond funds, you can hold those bonds to maturity, and you still get your full face amount back at the end, and you get your interest along the way, right? So tell us why you love bond funds so much, Jeff. I think our viewers and listeners would want to hear that.
I didn't hear your question, Dave. Can you repeat that?
I think our viewers and listeners would want to hear why you love bond mutual funds as much as you do. So why don't you go ahead and share that with them?
Dave, you're joking. I don't like bond mutual funds, and if you're a listener or a viewer, the last thing you want to own today is a bond mutual fund. There's much better mechanisms to create income from, as opposed to having bond turnover and passing on the losses and owning stock in a company that just owns a bunch of bonds. That's not going to be aligned with your priorities. And most investors are shocked and shaken when they realize, once we show them how they understand their bond mutual fund works, those bond mutual funds are not in line with what they wanted to accomplish and they thought it was originally.
Yeah. No, it's true. It's you study for your test to become an investment advisor, and you look at the definition of a bond fund. And Jeff, what you gave everyone is exactly correct. It's literally defined as the stock of a company that owns bonds. I mean, it even sounds riskier than a diversified portfolio of individual bonds. So I'm glad we were able to talk about that, because I want to make that clear for our viewers and listeners after what Peter had said. We take one more commercial break, but stay with us. We'll be back here in a moment, right here on the Income Generation. Welcome back to the Income Generation. I'm David Scranton, and I'm here with our friend and co-host, Jeff Small. So Jeff, let's talk now really about what our viewers and listeners really need to know at a time like this, because some people are thinking, gosh, we could have another wave of infections, things can go way back down, or maybe if the wave isn't that bad and all the stock market cheerleaders, push the market up, we can miss out on the best bull market ever. So let's talk about how we reconcile all that if we're part of the income generation, which we are.
All right, so I'm glad you asked that question because we really need to deal with the people that listen and view us every day. And so the reality is, the income generation, Dave, our viewers and listeners don't have fear of missing out on an opportunity, FOMO, because they think the market's going to run. They don't have FOMO. Where they are today is they just went through a beating. They went through a beating financially, and now it's a roller coaster, and they're finally starting to hold, they're still holding on to their positions because they want the market to come back so they can get out at some point again. But a lot of people are starting to liquidate, even now. And so what they don't want to do is they don't want to lose. That is their biggest concern for the income generation. They don't want to lose any part of their principal. And for anybody that's sticker shock from looking at their statements, the roller coaster of the last 60 to 90 days, they're saying this is too painful to watch. We don't want to lose any money in retirement. That's where they're coming from right now at this very second. Well,
I'd like to think that you're right, with the majority, and you're probably right with a slightly more than 50%. But I have to tell you that what concerns me is, you're an athlete, right? You were an athlete when you were younger. Maybe not anymore, right? None of us are, but you were an athlete when you were younger. And as an athlete, you tend to be competitive. You said that before in the show. And a lot of our viewers, a lot of our listeners, because especially men, because they're so competitive, they really want to rack up that score. They want to rack up that net worth, whether they need all that money or not. They already have enough to retire in many cases, but it's almost like a sport, And what I want to say to, most importantly to you, our income generation viewers, our income generation listeners, is that if you want to be competitive, pick a real sport. Don't do it with your life savings. Don't do it with your net worth. I mean, you've made sacrifices to accumulate this money over the course of your life, and your contact sport shouldn't be investing. And if you're physically at a point like Jeff and myself, where you're all busted up as you get to a more advanced age and you can't do contact sports anymore, well, take up chess and maybe be competitive in some outlet like chess or something else other than your complete net worth. So we need to leave it there now for this segment. And Jeff, I know you match my sentiment completely with that. And so good. So with that, let's take one last commercial break, and we'll come back for the last segment of our show coming up in just a minute, right here on the Income Generation. We'll be right back. Welcome back to the Income Generation. I want to take this opportunity to thank our special guest, Peter Morici, and also, as usual, our beloved co-host, Jeff Small, and most importantly, to thank you, our new and returning viewers. So, are the companies you're invested in being hit hard by the coronavirus pandemic? And if so, do they have enough cash reserves to weather the storm? Or by contrast, are they companies that are actually growing as a result of the crisis and that may continue to grow in this new corona economy? Those are the important questions, the ones that you're probably more likely to have answers to when you're in a diversified portfolio of individual bonds, bond-like instruments, and even dividend-paying stocks, as opposed to bond mutual funds or even stock mutual funds. Questions around cash reserves and whether a company is being adversely or positively affected by the current crisis are just some of the factors account managers consider when reviewing client portfolios on a daily basis. That's how an advisor who specializes in actively managed income-based strategies can not only help protect your investments from a real loss regardless of market conditions, but can also take advantage of opportunities to upgrade your portfolio for higher yields and more income in the future. And that's what makes investing for income the true strategic option for retirement planning, rather than gamble where the stakes can be extremely high at a time like this. It all starts with making that strategic shift from growth to income philosophically. Stay safe, everyone, and thanks for watching. If you're close to retirement, you really want to know how to protect and maximize your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll talk with you next week.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.